Most people in America say they want to be wealthy, but if you listen carefully to how they talk about money, you realize something strange happens beneath the surface. They speak about wealth as if it belongs to someone else. They describe rich people as lucky, connected, gifted, or somehow different. And the moment wealth becomes associated with other people, it quietly removes responsibility. Because if success belongs to someone else, then average becomes acceptable. That is where the divide begins. The top 10% financially are not separated by magic, intelligence, or even effort alone. They are separated by identity. The majority sees themselves as earners. The minority sees themselves as owners. And that difference changes every decision they make for decades. When most people receive income, their first thought is relief. Bills are covered, pressure decreases, and whatever is left becomes permission to upgrade life slightly. A better apartment, a newer car, a more comfortable lifestyle. It feels natural because income growth usually comes slowly, and small upgrades feel earned. But over time, that pattern locks them into a cycle where income and expenses rise together. There is no gap, no accumulation, no momentum. Meanwhile, the top tier treats income differently. To them, income is not the finish line. It is raw material. It is fuel. Instead of asking what they can buy, they ask what they can build. Instead of thinking about comfort, they think about control. And control comes from ownership. Ownership is the quiet engine of wealth in America. Stocks, businesses, equity, intellectual property, real estate, digital assets. These are not glamorous on a daily basis, but they separate people permanently over time. When you own pieces of productive systems, you are no longer trading time for money alone. You are attaching yourself to growth that continues even when you are not actively working. The average worker calculates life in hours. How many hours do I need to work to afford this? The investor calculates life in leverage. How many assets do I need so this pays for itself? That shift from labor to leverage is subtle at first, but over 20 years, it becomes explosive. Another reason 90% never reach the top tier is because they misunderstand risk. They fear the visible risks, like investing in markets that fluctuate or starting a side business that might fail. What they rarely fear is the invisible risk of stagnation. Depending entirely on a paycheck for 40 years is considered safe simply because it is common. But common does not mean secure. Entire industries disappear. Companies downsize. Inflation quietly reduces purchasing power every single year. Refusing to invest is not neutral. It is a decision with consequences. The top 10% understands that risk cannot be eliminated, only redirected. Instead of avoiding volatility, they design systems that benefit from it. Instead of trying to eliminate uncertainty, they build buffers and long-term positions that absorb shocks. Time horizon is another dividing line that most people never consciously think about. The majority operates financially in short cycles: next paycheck, next bill, next vacation, next holiday season. Even when they invest, they monitor performance weekly and react emotionally to normal fluctuations. But compounding does not reward emotional reactions. It rewards patience. The wealthiest individuals think in decades. They assume downturns will happen. They assume recessions will occur. They assume markets will correct. Because they assume these events are inevitable, they do not panic when they arrive. They prepare for them. And preparation makes volatility an opportunity instead of a threat. Cultural pressure also plays a powerful role in keeping people average. In America, visible wealth is easy to imitate. Financing exists for nearly everything. You can drive a luxury vehicle with minimal savings. You can wear expensive brands without owning assets. Social media magnifies this illusion daily. People see curated lifestyles and confuse consumption with success. But the truth is that real net worth is invisible. It lives in brokerage accounts, equity stakes, retained earnings, and tax-efficient structures. It does not announce itself publicly. The top 10% does not optimize for appearance. They optimize for resilience and growth. That difference may not look dramatic at 25, but at 45, it is undeniable. There is also a psychological component that rarely gets discussed. Most people never decide they are builders of capital. They decide they are workers trying to survive. And once survival becomes the identity, every financial decision revolves around immediate comfort. Builders, on the other hand, tolerate temporary discomfort because they see money as a seed rather than a reward. A seed is not meant to be spent immediately. It is meant to be planted. The earlier someone adopts that identity, the more powerful compounding becomes. 10 years of disciplined investing in your 20s is radically different from starting in your 40s, not because of intelligence, but because of time. Another overlooked factor is skill acquisition. The majority chooses careers based solely on stability or familiarity. The minority considers scalability. They look for roles with upside, commission structures, equity participation, performance-based growth, or transferable skills that increase earning power. Instead of negotiating only salary, they negotiate position. Instead of thinking about next year's raise, they think about long-term leverage. In a country with one of the largest capital markets in the world, access to wealth-building tools is widespread. What is scarce is the discipline to use them consistently. Financial stagnation rarely happens because of one catastrophic mistake. It happens because of small habits repeated for years. Not investing early, increasing lifestyle with every raise, carrying manageable but unnecessary debt, avoiding financial literacy because it feels complicated. Each choice seems harmless in isolation. Together, they shape decades. Meanwhile, the top tier stacks advantages quietly. Automatic investments, reinvested dividends, tax efficiency strategies, side income experiments, strategic networking. None of these actions are dramatic, but they are directional, and direction maintained long enough becomes destiny. Perhaps the most uncomfortable truth is that wealth accumulation is not exciting most of the time. It is repetitive. It is methodical. It requires saying no when upgrades are tempting. It requires ignoring noise when headlines are dramatic. It requires thinking independently when cultural pressure pushes consumption. That is why 90% never reach the top tier. Not because they are incapable, but because they never commit to a system that outlasts emotion. At some point, the individuals who cross into the top 10% stop asking whether wealth is realistic and start asking what structure would make it inevitable. They calculate. They project, they reverse engineer goals, they understand how much capital is required and what rate of return is necessary. They create systems that operate whether they feel motivated or not. And once that system is fed consistently, the math takes over. Compounding does not care about mood. It cares about consistency. The difference between 90% and 10% is not loud. It does not look dramatic on social media. It is quiet decisions repeated thousands of times. It is choosing ownership over appearance, leverage over labor alone, long-term positioning over short-term comfort. The American system rewards those who understand it. Markets reward patience. Tax structures reward investors. Businesses reward equity holders. The opportunity exists, but it does not chase anyone. It responds to structure. And the moment someone shifts from thinking like a consumer in the economy to thinking like an owner within it, the trajectory changes permanently. Not overnight, not instantly, but inevitably.